home ecosystem, as the company has branded it, is capable of leveraging new product releases by other innovators within the industry, in addition to new product releases by consultants. Over the past 5 years, the company has experienced a 12.9% sales CAGR and an 18.7% operating income CAGR. Fueled by exceptional growth in IoT connected devices with a 5-year CAGR of smart buildings and smart home devices of 34% and 31% respectively, as well as a stable outlook in housing starts, Control4 Corporation is well positioned to capitalize on trends within the industry. New domestic production facilities should allow the company to increase gross margins to their long-term goal of 54%, as well as decrease overall operating expenses as a percentage of revenue. Though the majority of past growth has been organic, Control4 recently completed several acquisitions, including NEO AG in February of 2019. Expanding internationally has been one of the company's top priorities, as the international market presents a large and underpenetrated opportunity for growth. Increasing authorized dealer base domestically and internationally will allow the company for greater market share and brand awareness among consumers. Based on these factors, it is recommended that Control4 be added to the AIM Equity Fund with a price tag of $21, representing a 25.7% potential upside. Moving on to my thesis. Firstly, gross margin expansion. Control4 has maintained consistent gross margins of around 50 to 51% since its IPO in 2013. However, recent development and positive guidance from management have sparked optimism around the company's ability to increase profitability. Management has stated expectations of long-term gross margin to expand to 54% of revenue, compared to 52% in 2018. Behind this expansion is the opening of a second North American distribution facility in Kentucky and the expansion of a similar facility in Melbourne, Australia. These facilities will cut shipping and installation expenses and allow for greater efficiency in serving domestic customers who represent the greatest market and servicing the Asia Pacific, where the company has focused efforts on expanding internationally. By reaching the long-term goal of 54% gross margin, Control4 would boost EPS by roughly 23% annually and add 15.9% to the intrinsic value. Secondly, an underpenetrated market. Domestically, Control4 has a 1.6% penetration rate within their premium customer segment, which represented 35% of revenue in 2018. Expanding dealer footprint is management's strategic plan to increase penetration by working with larger dealers, broadening the expertise of existing dealers, and introducing new products. At the end of 2018, the company had 5,400 active dealers in 103 countries, with plans to add more and expand into new areas. While authorized dealers have grown at a 5-year CAGR of 11%, international authorized dealers have grown at an impressive CAGR of 18%. Existing dealers have also become more profitable, as total revenue per dealer has grown at a 5-year CAGR of 5%. In 2019, Control4 will expand into Ireland, New Zealand, and Switzerland, and these increases in authorized dealers will be the primary driver behind future growth. Lastly, the future of the Internet of Things. Control4 stands to benefit significantly from mainstream acceptance of Internet of Things technology. Connected devices are expected to grow to over 62 billion by 2022, including over 26 million smart buildings and over 100 million smart home devices. Control4's open source platform will allow the company to leverage this growth through its interoperability with third-party devices and the ease of integrating existing devices, new devices onto existing systems through simple device discovery protocol, which is increasingly being built into smart devices. Now moving on to my valuation. In order to reach an intrinsic value for Control4, a 5-year DCF model was constructed using a terminal growth rate of 2% and a WACC of 10.61%. An intrinsic value of $21.66 was reached. The sensitivity analysis on the terminal growth rate and WACC ranged from $18.79 to $25.75. Additionally, a P multiple valuation was calculated using 2019 estimated EPS of 72 cents and a blended average P multiple of 28.19 times, resulting in an intrinsic value of $20.20. Finally, an EV to EBITDA multiple calculation was conducted using a blended average EV to EBITDA multiple of 15.35 times, resulting in an intrinsic value of $19.85. By weighting these models 60-20-20, a price target of $21 was reached, resulting in a potential 25.7% upside. Control4 does not pay dividends. Now moving on to my risks. Firstly, the entrance of large tech companies. In recent years, tech giants such as Amazon, Apple, Google, and Samsung have developed controlling capabilities within some of their smart home solutions. Products such as Amazon's Alexa have larger consumer awareness and can take away market share from Control4. However, none of these companies offers a unified open source platform, instead opting for individual and non-integrated products. Secondly, the reliance on the housing market. Control4's revenues generally fluctuate with the health of the housing market, which is subject to many factors outside of company control. An economic downturn resulting in fewer residential remodeling projects or fewer housing starts can have an adverse effect on future revenues. Lastly, tariffs. The recent trade war between the United States and China has had a slight negative impact on company profitability, causing Control4 to absorb increased costs associated with production. A proposed increase in tariffs from 10 to 25% would have a negative material effect on gross margins by roughly 60 to 70 basis points. Now moving on to my management. Martin Plain has been CEO and president of Control4 since 2011 and led the company through its successful IPO in 2013, where the company beat valuation targets by roughly 70%. And with that, I'd like to open up to questions.
All right. Thank you, Derek. Let's begin. Eric?
So I had a question about like generating revenue. So is this basically a product that they sell to people and that's the only time they get revenue, or is it like a reoccurring subscription kind of thing?
So both. The majority of the revenue comes from the installation of multiple products at once, and then the sale of controllers, which are able to control either at home or remotely. They've also introduced this subscription service called Foresight, which is growing pretty rapidly and is able to expand the gross margin to recurring revenues.
Andy?
Yeah, so in 2019, you have operating income growing at about 6%. Yet your EPS goes down almost a dollar from $1.67 to 72 cents. Can you talk about why that is?
Absolutely. So in 2018, the company was able to artificially boost EPS through the release of a net operating loss carry forward. So their income before taxes was roughly $20 million, and they recognized a $20 million income tax benefit.
So like if 17 were on there and like 16 and 17, would that be like a little more normal out?
Yeah, it would be closer to what you'd see with a consistent.
Okay.
Gino?
Just touching on your first driver, you mentioned that there's recent developments, and that's why gross margin is going to expand.
Yeah.
And we talk about the plants. Is there any other ones?
Yeah, so like I just mentioned to Eric, they're increasing their Foresight subscription service, which if you know anything about software as a service and those subscription platforms, they have really high gross margins, and they're able to replicate that technology without increasing or recognizing future costs.
And then just real quick, how did you teach your beta in black?
Yeah. So my beta of 1.33 I got from Bloomberg, and then my risk premium of 8.62% I got from Vanguard. So those two together combined with having no debt, so no cost of debt is where I got my back from.
Okay.
So I see it's like no debt, but in their investing activities, they keep every year they're buying and selling these available for sale short-term investments, which could be kind of acting as a bit of a proxy for debt in the short term. Is there anything? Did you look into what these are exactly? Is available for sale investments?
No, I did not. I'll have to get back to you.
Can you talk about the difference between the premium customer and the regular customer, and kind of like how you see that?
Yeah, so the premium customer represents Control4's largest customer segment, about 35% of revenue. Those are kind of like middle-class homes, aged 35 to 55, children, college educated. They're looking to expand that. Their luxury segment is above that, with more upper-class individuals representing about 25%, and then their bottom two tiers represent the remainder of that.
Ben, just to get an understanding of this company, what are they doing differently than Sonos? I would use Sonos before, but what is Control4?
Yeah, so I mean, Sonos only offers like sound systems, connected sound systems. What Control4 does is they're able to integrate Sonos and other companies that make smart home products to have a connected, controllable home. So where a customer with Sonos might only have 3 devices, the average customer who has a Control4 product has over 40 devices in their home.
Bill? Okay. Why is the stock down over 50%? That's high. It looks like me, as an experience, would say that they missed an earnings number here.
Yeah, earnings in the past year were a little bit disappointing.
And what was the cause?
Revenues came in less than expected. They had increased costs with their domestic production facilities, which were priced in 2018.
Shay, then Gio.
If we were to kind of go into an economic downturn, would they be still able to sell their products to people, to consumers?
Yeah, I mean, I believe so. They weathered the storm in 2008. If you're talking about the reliance on the housing market, they were able to shift their revenue mix. Historically, they're about 50% new homes and 50% existing homes with residential remodeling. In 2008 and 2009, they were able to shift that to 30-70. So I feel comfortable that they'd be able to do it.
Yeah.
So then, I'm with Ben, I don't know if I understand it correctly, could they use other companies' products like Nets
Yeah.
and stuff like that to connect everything, or is it only Control4 products that can make your life smart?
So the majority of products that they're interoperable with are third-party devices. They
Okay.
do have some of their own. Like I mentioned, they recently acquired NEOAG,
Yeah.
which is part of their growth strategy. But the majority of them are third-party devices like Alexa or things like that.
Oh,
Last question, what would you sell?
I would sell Methode Electronics. They've experienced a lot of top line growth, but that has actually contributed to negative bottom line growth. They've also they have a large customer concentration. So GM and Ford represent about 60% of their sales, and both those companies have offered negative guidance about future revenue outlooks. So I think it'd be smart to.
Very quickly, again, that one major risk is that Amazon or Google or somebody, Microsoft Apple step into that marketplace. How big of that is that a risk? And what do you think about that?
I think it's definitely the most important risk that we pay attention to, but I think Control4 is somewhat shielded from that, from their ability to integrate with those devices. So, but like I said, Alexa has larger consumer awareness, but what Control4 are doing is they actually, the SDVP, which I mentioned, that's increasingly being built into those devices. So Amazon is embedding this in their device to increase ease of integrating onto the system. So I think it presents somewhat of a risk because they're simpler and it's more cost effective. But when you're looking at where Control4 is looking to expand the customer segments, I don't know if they're really the same.
Very good. Thank you, Derek. Next presenter is Nate.
Hello, everyone. I'm Nate Zirpolo. I'm a junior in the program studying finance. I cover the domestic consumer discretionary sector. When looking for a company to pitch, I wanted to find a high-quality firm, consistent revenues, and a strong growth strategy in place for 2019 and 2020. Years in which Bloomberg economists, the Federal Reserve, and the Marquette program believe we'll have low GDP growth leading to a weaker economy. As an analyst in the consumer discretionary sector, it's key for me to find a firm that can absorb an economic downturn and have consistent revenue growth in years where Americans have less and less disposable income to spend. So with that, I found Monro, ticker MNRO. Monro Inc. is an automotive service provider that specializes in undercar repair and tire service. Revenue is recorded upon the completion of the following sales mix: tires, which is half the revenue, followed by maintenance, brakes, steering, and exhaust. Monro operates over 1,000 locations in 27 states across the Midwest and East Coast, and is headquartered in Rochester, New York. So now in America. In a $300 billion industry with over 500,000 businesses, Monro has been able to sustain long-term growth by becoming a major consolidator of the automotive aftermarket. Monro has been able to generate consistent sales growth in both strong and weak economies, as seen in the 10-year sales CAGR of 9.9% and the 10-year operating income CAGR of 12.3%. Due to technological advancements, the automotive aftermarket industry has consolidated in recent years. To compensate for this change, Monro has looked to complete acquisitions. Recently, Monro has been able to diversify their M&A strategy, acquiring more tire-oriented stores, knowing that tires encompass over half of the market potential of the automotive aftermarket. Accretive acquisition opportunities serve as the main pillar of Monro's growth strategy, with the firm spending approximately $46 million on acquisitions for the first 3 quarters of 2019. Last quarter, Monro introduced a modernized retail website with improved functionality and content. This led to better online customer interaction, resulting in an increase of 32% in online tire searches and an 80% increase in mobile phone conversion rates. Due to the firm's ability to successfully integrate new stores and their focus on improving an omni-channel presence, it is recommended that Monro Inc. be added to the AIM equity fund with a price target of $100.58. Now on to my drivers. So as previously stated, Monro has been able to generate consistent sales in both strong and weak economies. Monro experienced revenue growth of 5.31% in 2008 and 8.36% in 2009, which can be attributed to 6.7% increase in same-store sales in 2009 and a 7.2% increase in 2010. This increase in same-store sales was not seen by their main competitor, Pep Boys, during the same period, which they actually experienced negative same-store sales. If the economy were to slow down, which is looking like it will, Monro could see customers return to their stores at a greater rate than in times of economic growth. Now on to my second driver. So Monro's revenue is directly correlated with the overall number and age of vehicles in operation. Over the next several years, it is expected for the total number of vehicles in operation to grow, with vehicles 6 years or older representing a majority of cars on the road. So basically, after the recession in 2008, new car sales declined from around 16.5 million in 2007 to about 9 million in 2008. And then that number didn't return to pre-recessionary highs or where it was pre-recession until like 2012. So if they service cars that are like 6 years old and out of their warranty, they should be starting to see an increase in demand for cars bought around 2012 and after. Because of this, Monro expects there to be more opportunity to service vehicles than ever before, which could lead to further revenue growth. And my last driver, omni-channel presence. To further improve their omni-channel presence, Monro recently announced a partnership with Amazon. Monro is set to make $120 per installation for an Amazon customer, with first-time customers representing half of Amazon's traffic. With all 1,170 stores expected to be paired with Amazon by 2020, higher traffic trends could increase future same-store sales and revenue numbers. And very quickly, I'll touch on my valuation. In order to reach an intrinsic value of Monro, a 5-year DCF was constructed using a terminal growth rate of 2% and a WACC of 7.8%. Intrinsic value of $108.88 was reached. Additionally, a PE and price to book value multiple valuation was conducted. I weighted these three models 60, 20, 20 respectively, and a price target of $100.58 was reached. And Monro pays a 1% dividend. Due to the interest of time, I'm going to skip my risks and management. Feel free to ask your questions about that, but I'll open up for questions.
Are you predicting a market pullback in your model?
Yes.
Can you walk us through that?
Sure. So I did take into consideration the market slowing down. So that's why revenue doesn't really increase. They do project revenue, strong revenue numbers. It's just not as strong as it would in a strong economy. I do increase interest expense, and that's, if you're wondering about my operating margin or my operating income growth rate, I do increase interest expense to kind of compensate for all the acquisitions they've been making. So yeah.
What year specifically are you looking at?
For what?
For recession or pullback?
End of this year, starting next year.
So my question is like a couple parts, I think. So first off, I don't really like your peer valuation box.
Sure. Yeah.
So just kind of looking at this, like your price, can you kind of talk about
Yeah, I get
your weights for your price to earnings?
Sure.
Then I have another question.
Yeah. So this kind of ties into Dr. Wall's question. I did want to find peers that had acquisitions along with peers that kind of focused on the other half of the company's like the service part. And Dr. Wall's question, he kind of was confused why I didn't choose tire-based firms, and also not why I didn't choose acquisition-based firms. PEs for tire-based firms are generally lower than the PE I have, but the PEs for acquisition-based firms are higher. So if I did include acquisition-based firms, which this company is, in my peers, it would generate a higher projected upside.
Good call.
Then my second question is, how is your blended price to book higher than all of your individual price to books?
Yeah, so I weighted them differently. I don't have the weights in front of me, but I can.
How do you weight them and get a higher price to book than all of them?
I'd have to get back to that.
You know. So weird question, but in 2017, or 2007, 2008, 2009, they had revenues increasing.
Yeah.
But then just like operating margins like went down.
Mhm.
Where do you have, if you are projecting like an economic downturn, where do you have like operating margins relative to where they've been in the past?
Yeah, so I do think this is a more advanced company than 10 years ago. They've kind of changed their strategy of acquiring more companies as the time with like technology. They've kind of had to move more into a consolidating based firm. So I think that they do have like a strong position even now going into what can be
Yeah, so one of your main drivers is, of course, all 1,170 stores like partnering up with Amazon by 2020.
Yeah.
I guess kind of going off that, do you have any figures or?
Sure. Yeah. So a normal customer, they make $160 off of a normal customer. Ones on Amazon, they make $120. But the key figure that I read is over half of their customers that come in through Amazon are new customers. They're currently operating in 57 stores right now, kind of a trial run. This was announced last quarter. Another point to add about Amazon is that their main competitors are kind of fending off Amazon, which I thought was interesting that they would want to be with Amazon. I think that's a strong position to hold.
Yeah, I had two questions regarding the price to book.
Sure.
First of all, would be why you think price to book is a good valuation for this type of firm, and then secondly on that, you're projecting a recession, or at least an economic bit of a slowdown.
Yeah.
And then you have multiples expanding by 1.2 times or so. Could you please speak to that?
Sure. So I chose the price to book because I thought it correlated well with their ROE. I also think that like price to book closer to 1 suggests that they're kind of undervalued. They do have a price to book that's lower than those comps, and with comps that are acquisition based, it is lower as well. What was the second part?
Yeah, and just the fact that you're talking about economic pullback and then, expanding margins so significantly on that price.
Yeah, so I think that in my pitch, I've kind of stated how there's multiple factors that if there is to be an economic downturn, that this company would be less affected than other consumer discretionary companies. When people are constrained to spend their money and disposable income, which is kind of free money to spend, is low, I think that this would come first before any other companies. So that's kind of my reason.
We've got time for 2 more questions. Penny?
Yeah, so obviously technology has been rapidly. I didn't touch on the education that to compensate for that risk.
Yeah, so they're kind of switching from maintenance to tires. So that's one way to compensate for technology. The other way is they're kind of re-imaging a lot of their stores. They've devoted $75 million in CapEx to kind of boosting up technology in stores to kind of service cars with tires.
Last question.
So there was a recent stock increase price on 6%.
Yeah, so the firm actually, it kind of goes with their acquisitions. They recently purchased, they're expanding to California. They made a deal with Certified Tire and Service Centers, which is yesterday, which was why the stock went up 6%. It's interesting though, because they're based in the East Coast and Midwest. And I did read that they have plans to expand to the West, but not just to California, which is very far west. So I think there's even more opportunity there because they're not just going to open 40 stores in California. They're going to kind of expand to that region. So that's.
What's your sell?
Planet Fitness. I think we don't have to sell all of it, but I think just to bring the weight down, the AIM program has done very well on that company, and I think it's a good time.
All right, thank you. Next presenter is Alex. We're right on schedule. So we're fine.
Yep. All set. Hi everyone, I'm Alex Penkwitz and I'm a junior in the AIM program covering the international information technology sector, and today I will be pitching Globant, SA, ticker GLOB. Globant SA operates as a technology services firm providing engineering, design, and innovation services for clients. Globant has 7 total business segments, with the 4 main business segments being media and entertainment, banks, financial services and insurance, travel and hospitality, and technology and telecommunications. Globant generates a majority of its revenue from the United States, followed by Spain, Chile, and Argentina. Globant currently has 8,384 employees that address a global customer base consisting of 373 firms. Globant SA was founded in 2003 and is headquartered in Luxembourg. Globant SA completed their IPO in 2014 that has since developed into a dominating force in the technology services industry. Globant has generated strong growth since their IPO, experiencing a 5-year sales CAGR of 21.21% and an operating income CAGR of 24.73% over the same time period. Globant currently has the 6th highest market share in the software design and engineering consulting industry. Revenue per employee is up 4% year over year, while increasing the number of employees by over 300 people, which displays the talent and efficiency of the company's workforce. Globant currently has 20 different service offerings or studios, which allow for an assortment of cross-selling opportunities within their current relationships. In 2016, Globant initiated a strategy which aims their efforts towards the top 50 customers with the highest potential growth, which they labeled as 50 squared. This strategy has proven to be effective, increasing the amount of $20 million, $10 million, and $1 million accounts compared to fiscal year 17. While just 38% of annual revenue comes from long-term contracts, about 85% of the company's annual revenue can be attributed to customers who use their services in the previous year. Globant presents an impressive top customer list consisting of Walt Disney Parks and Resorts Online, Southwest Airlines Company, Electronic Arts Inc., amongst many others. In addition to these customers, Globant was the first offshore company to sign Google as a customer. With rapid growth in service offerings involving disruptive technologies, considerable margin expansion, and the emergence of service over platform, it is recommended that Globant SA be added to the AIM International Equity Fund with a price target of $86.28, representing a potential upside of 21.37%. And now on to my investment thesis. My first driver, disruptive studio offerings. 2 of Globant's fastest growing studios are artificial intelligence and big data. As corporations look toward ways to become more efficient, they have increased their dependency on these technologies to better utilize information. According to Allied Market Research, the global artificial intelligence market is projected to reach $169.4 billion in 2025, growing 304% from $4.1 billion in 2016. In addition, Forbes estimates that the global market for data analytics will grow 56% from $130 million in 2016 to reach $203 billion by 2020. This presents a great opportunity for Globant to capture growth from current customers as well as potential new customers. My second driver, employee retention resulting in margin expansion. Upon completing their IPO, Globant's SG&A expenses represented 35% of revenues. SG&A currently represents nearly 26% of total revenues, contributing to a 101% growth in operating income and a 59% growth in operating margin. By expanding into different locations globally, Globant provides employees with various options on where to work as well as becoming geographically closer to customers. This option for employees has benefited their attrition rate, decreasing by nearly 100 basis points compared to fiscal year 17. In result, management expects SG&A expenses to decrease 50 basis points each year for the next 4 to 5 years. By retaining talented employees, Globant is able to decrease SG&A expenses and increase their operating margin by an average of 30 basis points per year, which can be noted in my boxes. And lastly, services over platform emergence. SOP is a new concept to the technology services industry, which, while priced the same as software as a service, SOP is similar to SaaS, with the main difference being SaaS offers a basic application that you get on a subscription basis. SOP offers modifications to the initial platform provided based on a subscription basis. With SOP, clients are able to get personalized, improving platforms rather than the initial standard platform. SOP products offer the flexibility to adapt to customers' needs using Globant's microservices to complement initially provided platforms. The main advantage to this product offering is the recurring revenue that is secured. Like I explained, after the initial platform installation, Globant remains involved with the client by continuously catering the technology to specific preferences over time. SOP earned Globant $5.22 million in fiscal year 18 and is projected by management to represent between 5% and 10% of total revenue in the next 5 years. On to my valuation. In order to reach an intrinsic value for Globant, a 5-year DCF model was constructed using a terminal growth rate of 2.25%, and a WACC of 9.38%, and intrinsic value of 87.61 returns. A sensitivity analysis of plus or minus 25 basis points on the terminal growth rate and WACC ranged from $82.60 to $93.27. Additionally, a PE multiple valuation was calculated using a 2019 estimated EPS of $1.88 and utilizing an average 2019 estimated PE multiple of 41.75 times, resulted in an intrinsic value of $78.40. Finally, an EV to EBITDA multiple was valuation was calculated using an average 2019 estimated EV to EBITDA multiple of 26.95 times, resulting in an intrinsic value of $90.18. By weighing the three models 60-20-20, a price target of $86.28 was reached, resulting in a 21.73% potential upside. Globant does not pay a dividend. And to touch on my risks, there's high customer concentration. Globant's 10 largest clients have been serviced for an average of 7 years and have historically accounted for about 40% of annual revenues. In the fourth quarter of fiscal year 18, the top 1, 5, and 10 clients accounted for 10.9%, 30.9%, and 42.7% of total revenues, respectively. And Argentina instability. Globant's main operating subsidiary resides in Buenos Aires, Argentina. Only 3.6% of fiscal year 18 revenues were derived in Argentina, but the economic and political uncertainty may pose unfavorable wage inflation for Globant. And just to touch on management, in addition to what I have written, I believe it is important to note that the other two co-founders, and excuse my pronunciation for these names, Marin Gonzalo Umaran and Nestor Nassetti, are both still active in the company, acting as director and chief of staff and executive vice president of corporate affairs, respectively. I'll now open the floor.
Okay, so let's start with the last question first. What will you sell?
I'll be selling Taiwan Semiconductors. They've been in the portfolio since, I believe, February of 2017 and have not seen any of their investment thesis pan out. And yeah, so they're reaching their 2-year investment thesis.
Okay, thank you. Dino.
They've had plus 25% revenue growth all the way back since their IPO, I think. Is that all organic?
Yeah, so they do make acquisitions, but 1 or 2 a year, nothing very large. Their strategy was basically that they want to acquire companies that had offerings rather than brought in their company as a total. So they're making acquisitions, but nothing extremely large. But yes, this is mostly organic.
Derek.
So just looking at your comps, it seems like blended average being pulled up a lot by Benefit One.
Yeah, so I did think that they were a good competitor, but to address your question, which was about Benefit One and how they're pulling my valuation up, if I were to take them out of my valuation, which I did, and I weighted the other competitors evenly at 25%, I would still have a 17.5% upside total. So they don't really have that large of an impact on my company, but yeah, they have upside.
Andy.
Yeah, with this, the new SOP, services over platform, do you have that, like, did you model that in at all? And how did you do that if you did?
Yeah, so SOP is currently considered in their other segment. So what I did was I took 1% of total revenue out of their entire revenue, and I pulled that from the other section, and I made that 5.22 for fiscal year 18. And then I projected SOP as its own business segment and increased it as a percentage of revenue each year by about 1.3%. And I had it reaching 6.7 in 2013, which is on the lower side of what management's projecting. I just want to be conservative.
Okay, Bill.
This is a body business, right? And it's called consultants. Have they been able to increase their consultants as fast as their growth rate? Have they ever missed the quarter based upon their hiring?
Not that I know of. The question was in regards to have they been able to consistently increase the amount of employees that they have, correct? They have not been slowing their growth in employees, but their revenues are growing faster than how much they are growing their employees.
Our new Joel Wall, Eric.
Yeah.
Can you talk about why you use EV to EBITDA as a valuation metric when your company has no debt, but all your peers do, and it essentially rewards your company for this?
Yeah, I thought that it reflected my company's ability to indeed gain cash flow without using debt. So what I thought was a benefit to their company and how that they're generating their revenues compared to other companies was a benefit to them. So that's why I use EV.
so Dr. Wall's question, and I'm kind of going similar to that is, any relative valves, your pumps are foreign, how did you adjust for currency?
Yeah, so for every single competitor that I used, I took their price in the home currency and converted it to the US, as well as their FactSet estimated EPS. I have each conversion right up here if you want me to walk through it, but I can, no, that'll take too long, but yeah, that's what I did. So I just did their original price that they have converted back using a conversion rate.
First sophomore question, man.
So with a P of almost 50, and there was a recent rally, and it's on decreasing volume. I was just wondering why buy it now?
Well, yeah, if you look at their growth projections that all analysts have, as well as myself, this isn't something that's going to slow down necessarily. It is going to slow gradually, but they're still generating 20% growth, so it's still a really good opportunity to buy in. We might be a little late, what I think, but yeah, it's still a great opportunity to catch some of that growth.
Explain SOP as if you're explaining it to your uncle.
It's basically they provide you with a platform of technology, and they'll give you microservices to enhance it and make it better over time.
I think his uncle got that. Your turn. Thank you.
For this high customer concentration.
Yeah.
For these 1, 5, and 10 clients, for the past year, like for the past prior 5 years, is it the same customer or have they switched?
Yeah. So if you look I think I have it in my wrist. They have an average of 7 years that they've been working with these customers. So they developed a really good relationship with them, and they don't see pricing demands as being that large of a risk.
All right. Very good. Thank you, Alex. Okay, we're right on schedule. Nick Arco, the commissioner of the
bracket challenge.
Yeah, bracket.
Get your money into me.
Yeah.
All right.
Is this going to be a utility?
It is not a utility. Just to get that one out of the way. So, hi everybody. My name is Nick Arco. I'm a junior in the program, and I cover domestic technology. So today I'm going to be pitching SolarWinds, ticker SWI. SolarWinds is a leading provider of IT infrastructure management software. Selling to companies of all sizes, their broad portfolio of products allows IT professionals to manage and monitor their IT environments, whether they are on-premise, in the cloud, or in hybrid models. 65% of the company's 2018 revenues came from the US, while 190 other countries comprise the remaining 35%, none of them contributing more than 10%. SolarWinds recognizes revenues in the form of subscriptions, which was 32% of their 2018 revenues, maintenance, which was 48% of 2018 revenues, and licenses, which was 20% of 2018 revenues. After 7 years as a public company, SolarWinds was taken private by Silver Lake and Thoma Bravo in 2016. This gave the company the ability to focus on its long-term strategy without pressure from stockholders. In 2018, surveys of chief information officers done by both SolarWinds and JP Morgan indicated that cloud/hybrid IT is one of the top technological priorities for companies today, and that by 2022, about half of all workloads will be cloud-based. After this rapid shift towards hybrid models, that number is expected to plateau, as some workloads will need to remain on-premise due to security concerns, leaving about 50% of workloads in the cloud and about 50% on-premise. SolarWinds is very well positioned to take advantage of the shift towards hybrid models, as they've expanded their cloud portfolio from one product to four to complement their on-premise products, existing on-premise products that they had prior to their take private. SolarWinds has also made key moves to better attack another rapidly growing area, the cloud-based MSP market, through acquisitions like LogicNow in 2016. Furthermore, they are able to do all this while keeping their offering 70% lower than competition by designing products that not only solve complex IT issues without the need for customization, but can be downloaded from the company website, which shortens the sales cycle from weeks to hours. These moves have given SolarWinds the highest market share in network management, the fourth highest in systems management. SolarWinds has a rare financial profile, and that it is one of 3 public tech companies with $900 million in estimated calendar 19 revenue, a 12% estimated revenue growth CAGR over the next 3 years, and a 49% estimated adjusted EBITDA margin. The other 2 public tech companies with these similar numbers are Facebook and Adobe. SolarWinds has a very large customer base that consists of all but one of the Fortune 500 companies, Office of the President, and the Pentagon. Among these customers, There's a very strong customer loyalty represented by the maintenance 95% renewal rate and 105% retention rate on subscription revenue. This is also representative of the sales team ability to grow customer account value and relationships. Based on its solid positioning and strong financial model, it is recommended that SolarWinds be added to the AIM Small Cap Equity Fund with a price target of $26.74, representing 32.65% upside. So on to my thesis. The first driver is deleveraging with top line growth. Part of what makes SolarWinds so unique is their strong financial profile. The company not only has strong EBITDA margins, 45% in 2018, but a significant unlevered free cash flow conversion rate, 84% of 2018 EBITDA, on top of a double-digit revenue growth rate, which is about 11% going forward. This is a rare financial profile in the software industry, which will bode well for SolarWinds in the case of a market downturn. In 2018, SolarWinds decreased its leverage ratio from 5 to just over 4, while simultaneously spending $60 million in acquisitions. The ability to generate such strong free cash flow is expected to persist, allowing the company to continue this trend of ample year-over-year deleverage while retaining the flexibility to make strategic investments as they see fit going forward. They've indicated that they will invest more heavily in Germany, and though they haven't given specific numbers on that, that's a market that they feel is quite large and pretty underpenetrated. The company is forecasting debt pay down, but if they were to pay off the entirety of their debt over the next 5 years, we would see an EPS benefit of an estimated 26 cents over what I projected, adding roughly $5 on the price target based on the current 19.56 PE multiple. My second driver is their low friction sales model. So part of the way SolarWinds differentiates themselves from competition is through their inside sales approach, which markets directly to IT professionals rather than CIOs. So initial smaller sales are made through the company website, and then after that, a sales rep will contact the customer and attempt to grow that account value. This greatly reduces their sales and marketing expenses, allowing them to keep their operating margins wide, holding S&M costs in the mid 20% range. And by comparison, their competitors generally remain in the mid 30% range when you look at it as a percentage of revenues. SolarWinds has seen success with this in the past, adding 6,000 new customers in each of the last 9 quarters, and they're expecting that to continue. While these deals start small, that's what's going to make up the pipeline that's going to drive that 5 to 10% growth in their number of 6-figure deals. Finally, their cloud and MSP push. They generate their subscription revenue from cloud and MSP products, which in part is what drives their recurring revenues. So in 2018, over 45% of SMBs were using a managed service provider, up from 17% in 2013. The company expects this number to ultimately get to 75% of the 3.2 million SMBs that are around today. So due to the increase in its cloud and MSP products, SolarWinds has seen their subscription revenues grow by 400% since 2015, which was just prior to their take private. And this has driven recurring revenues from 65% prior to the take private to 80% in 2018. Moreover, subscription revenues are expected to grow at 20% in the future and push recurring revenues in the mid 80% range in the medium term. So just to touch on my valuation, I used the DCF, an 8.45% WACC, 2.5% terminal growth rate, EV to EBITDA, and EV to free cash flow. Finally, I'll just touch on the management. I'll skip rest for time. But management, what's important here is that both the CEO and the CFO have been around for 13 years and 12 years respectively. And in that time, they've never seen they've never missed a bottom line. So with that, I can open up.
All right, let's start with what you'd sell.
I sell Paycom. That stock's up about 150% since we bought it. And I'm kind of pitching this with a similar story. So I'd like to make this swap because I feel like we're on the front end of this one and the back end of that one. So let's cash out on that and see if we can get this one in the same thing.
Here we go. I see you, Bill, but we got Gino first.
So just looking at their price chart, it seems like a beta of 1.17. I have two. It's a beta of 1.17 just seems a little low. Where do you get that?
So since they have only been public for 5 months, I feel comfortable using a beta from just based on their own performance. So I used a average of their account.
Did you take their capital structure into consideration when you took that average?
No, I just used the straight average.
Okay. And then for your EPS number, analysts have it at like 6 cents. You have it at what, 14?
It's not yet a number, I'm sure.
Okay.
Their interest coverage ratio is about like 1 right now. their beta is above 1. What happens if we have market downturn that everyone's expecting? Are they gonna be able to pay back that debt?
Yeah, I expect, based on their free cash flow, they're gonna be they, like I said, generate a lot of free cash flow, especially compared to their peers. So if we do start to see a bit of a pullback, they're gonna be able to perform fine. I don't imagine that that's really gonna hurt them too much. We saw in the financial crisis, what they had between 2007 and 2008, we saw 50% revenue growth, about 64% net income growth, and that was with a much smaller product portfolio. So if we were to hit a recession, I don't feel that would add.
Just to follow up quick, seems like most of their cash flow is either add back for depreciation or from financing activities from like new equity, not like operating cash flows. Do you think operating cash flows are going to expand more than they are?
Yeah, I think they should expand.
Okay, we've got about 4 minutes and a lot of questions. Bill, you're first.
This may be just out of your scope. I used to own this stock when I was working, pre-2012, right?
Yeah.
This was a serial underperformer. And they had to be, I noticed here that management has not changed.
Right. Well, they've expanded their product portfolio pretty drastically. In 2012, it was mostly just on-premise products. And now with the shift towards cloud computing, which I think is what we've been seeing over the past few years, I think they're caught up and they're pretty well positioned to take advantage of the hybrid market that we're seeing. Whereas back at that time, they had a much smaller product portfolio that probably wasn't in the right position to take advantage of the market.
Okay, so your ROA and ROE are negative and you have a very low ROIC. What do you think that's concerning? What is that?
No, so ROA and ROE will go positive this coming year, and ROIC is 2.06 right now. If you were to keep their invested capital the same over the next 5 years, which it won't stay the same because they're going to keep paying down debt. By the 5th year, they would be at 7.25. If they were to pay off their entirety of their debt over the next 5 years, which is possible based on their free cash flow, then we're going to see that number at 14.5. So you can kind of do the math there in between.
Andy.
Yeah, could you answer the first 2 questions that Dr. Wall sent in his email on the top line to operating margins and then the operating income and earnings?
Yeah, so that additional leverage is going to come from a few different places. So the fact that recurring revenues are growing going forward, we're going to see the cost of sales continue to fall. We're also going to get rid of a lot of restructuring costs that were apparent in the 3 years that they were private. So we're going to get additional leverage there. As revenue grows, a lot of their G&A costs are fixed. So we're going to get more leverage there because that will start to go down as a percentage of revenues. We're also going to see R&D fall because they spent their time private developing cloud products. And now that they've kind of got that we're going to see research and development costs start to fall as a percentage of revenue. So there's going to be more leverage there. And then there's also quite a bit of amortization that they recognize above their operating income. And so that is projected to fall in the coming years. Now that would increase if we saw if they made more acquisitions, which is likely. But with that, we're also going to see more top line growth, which is going to offset that. And so we're going to see additional operating leverage come there. And then to touch on the EPS number, all of what I just said is the same. We're going to see a lot of that flow through. I did forecast debt pay down pretty conservatively. I think it's going to be more rapidly, but I have their interest expense decreasing pretty slowly. But if it's higher than I projected it to be, which I think is likely that it will be, then we're going to see EPS grow even more. But yeah, that's how the numbers flow through.
Short one, Sean.
Yeah, really quick. You already talked a pretty good amount. So the reason why the ROIC is pretty significantly less than the WACC is because they're trying to cover right now. Is that what you're talking, covering the debt?
They have a lot of debt, yeah, from the LBO. So
okay.
Yeah, as they pay that down, we're going to see that come up, and I think it should come up pretty quick.
Another short one question. Thomas, you had a quick one. You got a short one?
It's actually
Okay, Nate, you get the last one. That was it. Thank you. All right, hey, look for the ballot because we need to vote and place the transaction today. All right?